Buyers in the housing market have faced a challenging year. Following 3 consecutive summers of exorbitant price growth, many believed the long-awaited crash had arrived when the Case-Shiller index indicated a peak in prices last June. For 7 consecutive months, the market showed alarming signs as median prices declined at a pace worse than in 2006. Speculations arose that this marked the beginning of a new crash, leaving buyers burdened while sellers benefited. However, just as one side of the market celebrated, the new year brought a surprising twist. Despite record-high interest rates, the Case-Shiller index leveled out, and the market returned to its extravagant behavior. Open houses during spring became bustling affairs, multiple offers were commonplace, and absurd valuations once again became the norm. As a prospective buyer, you might be watching this video and wondering if this seemingly insane bubble will ever burst. Surprisingly, new evidence has emerged in the past week, revealing a couple of startling developments. It all starts with the inventory. When viewing the housing market through a simple mathematical lens, there are 2 essential factors: supply and demand. Although this might sound overly simplistic, the entire market rests on this foundational principle. Currently, everyone is aware that demand is lacking. By examining the most reliable proxy traditionally used to measure housing demand, the Mortgage Application Index, we witness a disaster. This index has reached historic lows not seen since the financial crisis of 2008. Even when looking at other measurements of demand, the story remains consistent. Demand is weak compared to previous years. Despite this, prices remain high and competition persists. This is primarily due to the fact that purchase applications no longer accurately represent today's demand. The other side of the equation, supply, is incredibly low. What we have now is a supply-constrained market. There is no recovery in demand. It's simply that there are very few houses available for sale. Despite the low demand, a strong floor has emerged in the market due to the scarcity, creating the illusion of a sturdy foundation. Demand figures are essentially misleading, and previous estimates based on these figures are no longer reliable. In this new world of limited supply, inventory is not increasing at the expected rate. The crux of the matter lies in new listings which are falling behind at alarming rates. Few homeowners in the United States are willing to sell their homes. This reluctance stems from the fact that most homeowners have witnessed a staggering appreciation of over 30% in the last 3 years. Additionally, they hold 30-year mortgages with interest rates well below 4% and sometimes as low as 2.6%. When comparing today's rates and prices, it becomes clear why homeowners who purchased before 2020 are essentially locked into their homes for the foreseeable future. While year-over-year statistics may not paint as dire a picture, as evident in a recent 2% rise in inventory levels compared to last year, the pure numbers can be deceiving. Technically, we have 44% more homes on the market than in 2022. However, as Mike Simonson of Altos Research explains, the focus should not solely be on year-over-year figures. In 2022, we were rebounding from all-time lows in inventory numbers, which skews the comparison. Last year, we had 75% more homes compared to 2021. This indicates a significant slowdown in the rate of inventory growth. Simonson estimates that by the end of the year, we will have around 500,000 single-family homes, an improvement compared to previous years, but still well below pre-2020 numbers. Returning to the basic principle of supply and demand, it becomes challenging for prices to decline if this constrained supply situation persists. If you are hoping for price declines and contemplating leaving this video, it's important to continue listening. While the current market may not offer immediate relief in terms of lower prices, there are still factors to consider. While it may seem discouraging that significant price declines are unlikely in the near term, there are other aspects to the market that may present opportunities. For instance, despite the high prices and competition, it's crucial to evaluate the long-term potential of real estate investments. The housing market has shown resilience and has the potential to provide stable returns over time. Additionally, it's essential to stay informed about any changes in market conditions and economic indicators. Keeping a close eye on trends such as interest rates, inventory levels, and buyer demand can help you make more informed decisions about when to enter or exit the market. However, before we delve into the hope for this volatile market, I kindly request a moment of your time to hit that like and subscribe button if you're enjoying the content thus far. Each thumbs up serves as a signal to the algorithm that you're finding value in the content, and I appreciate your support. Now, let's return to the discussion about timing the crash. If Mike's prediction holds true and supply reaches around 500,000 homes by the end of the year, the chances of significant price declines are minimal. So how do we reach that point? In my opinion, the only way is for the Federal Reserve to continue its battle against inflation by implementing rate hikes that exceed market expectations. The Fed has already raised rates to levels not seen in years, but an interesting phenomenon has occurred. Delinquencies and bankruptcies are at record lows, despite the fact that median house payments are more than double what they were in 2019. This means that homeowners, from a financial standpoint, appear to be in good shape. For any significant improvement in the housing market, Powell, the head of the Federal Reserve, needs to persist with rate hikes, even if the market anticipates a pause in the near future. However, it's important to note that the housing market won't see much improvement if this is indeed the case. Bankruptcies are at an all-time low, and the seemingly stressed buyers who typically provide available houses have disappeared from the market. Coupled with the fact that most homeowners have no inclination to sell, this creates a supply crisis. To rectify this situation, the Federal Reserve needs to continue tightening and eventually raise the unemployment rate. Unfortunately, in this market, significant relief for buyers will only come when the unemployment rate increases. If the current situation persists, real estate prices will remain stagnant. Buyers have demonstrated that they will continue to purchase the few available houses, even with mortgages as high as 7%. Essentially, a housing crash cannot occur without a recession, and that is a precarious situation. Hoping for a housing crash means hoping for others to lose their jobs while maintaining one's own. And it seems that we are headed towards a recession. Nearly every expert predicts challenging times ahead for every sector of the American economy. Even if we disregard expert opinions and focus solely on indicators like Treasury spreads, the outlook appears bleak. Treasury spreads, which have been reliable indicators in the past, currently suggest a 68% chance of economic turmoil in the U.S. A more specific indicator, the 13-18 forward favored by the Federal Reserve, reveals an even grimmer picture. It analyzes the yield spread between the 3-month and 18-month treasuries and shows a 94% chance of economic turmoil. This reading is the highest in decades. Past instances of significant market downturns such as the dot-com crash, the 2008 recession, and the 2020 crash have seen similar spikes in this indicator. Given these circumstances, it is clear that the future of the market is uncertain and challenging. It is essential to approach the situation with caution and consider the potential implications of economic downturns before making any decisions. The current state of the housing market can only be described as a transitional period. Following the post-2020 era, a bubble has emerged, and despite record low unemployment rates, the situation has taken a drastic turn. While prices haven't dropped yet, they have plateaued after an astonishing 36 months of rapid growth. This suggests a stabilization of the market, but if the projected recession materializes, we may face a scenario reminiscent of the 2008 financial crisis. However, if a recession does occur within the next year and unemployment rises, the factors that have made the housing market resilient for the past decade will undergo notable changes. It's crucial to examine the charts provided by Altos Research, illustrating sales and supply, to understand the potential outcomes. Over the past few months, as supply has increased, sales have followed suit, indicating that sellers still hold the advantage. Each time inventory expands, sales keep pace. However, the moment we witness a rise in inventory without a corresponding increase in sales, it will signify a true turning point in the market. Only then can we definitively declare the demise of the bubble and anticipate the final phase of the crash, marked by significant price declines. Thus far, price drops have been relatively mild compared to the previous year, indicating a lingering market imbalance despite substantial drops in demand. However, once this indicator begins to trend upward, It will trigger panic selling and make the market's downfall unmistakably clear. We appreciate your viewership, and for a more comprehensive analysis of inventory numbers, we encourage you to visit Altos Research's YouTube page, where they delve into the data in greater detail. As mentioned earlier, don't forget to like, subscribe, and leave a comment below to share your thoughts on this recent inventory redevelopment.